So hopefully this panel will get to the arguably the nub of the issue that we were debating there, which I think is, to a large extent, pricing. Okay, so I think the suitability debate in large part revolves around, are the crowd paying the right price, to put it in overly simplistic terms. And I think I've talked to all of you guys individually over the months and years about the price discovery process in equity crowdfunding and the challenges. And I suppose one thing which is interesting as a comparison is, how does price discovery work in quoted equity markets, where clearly, even with all those advantages they've got, even there it's an extremely difficult process. So there's an extensive roadshow process, extensive feedback process, thousands of overpaid investment bankers in the process, professional investors in the process, and yet still IPOs are very often mispriced. So I think, to consider that as some sort of a context, I just want to start by throwing it out there and getting you guys to reflect on the challenges in terms of accurately pricing early stage investment. And I guess, Dan, because you're closest and I've got to pick someone, I'm going to start with you.
Okay. So first of all, I would totally agree that this is not an easy process. And it's never been easy to value early stage companies. And if you look at kind of standard methodologies and techniques for doing that, discounted cash flow and multiples on EBITDA or whatever, they don't really work for these stage and types of companies. So at the end of the day, you find yourself with essentially a transaction which is a buy on one side and sell on the other, and we're a marketplace in between, and it's incumbent on us to try and find the right price so that the transaction can happen. And the way that we view ourselves is we are that marketplace, we are trying to make the transaction happen. We're not on either side, and it doesn't benefit us one way or another which way the pricing goes. But it's really important for us to try and get that pricing right. And there's two ways that we can do that. The first way is to do financial analysis on the company and use our experience of having funded now hundreds of companies over the last few years to try and work out, comparing to examples of similar companies in the past that have raised, what is the right kind of band of value for that company. And that goes along with negotiation with the company itself, because they're going to come with an idea of what they think their valuation would be. And then at the end of the day, you have to put that to the test. You put it on the platform and you'll find out quite quickly whether it's right or not. But during the process, whilst the pitch is then live, as I think Julia mentioned before, there is a discussion forum on there, and there's the opportunity for investors to give feedback. And it's normally the first question on a forum is, how did you get to your valuation? And our companies are very well prepared for that. And ultimately, you're going to find out during that process whether you got the valuation right or not. And there's examples on our site and on others, I'm sure, of getting it right and getting it wrong. And the other way, which I'm sure the other guys will talk about a lot more as well, is when a company comes to raise money, they've got an existing investor in that round who has already negotiated a price. And essentially, you don't really have a lot of say in that point what the pricing is, because it's already been set by and crystallized by that institutional or lead angel investor.
So it's interesting, this idea that the first question can often be on the message board, how did you arrive at the valuation? Do we think, and I'm going to move to you guys next, and there might be all sorts of issues that Darren raised that you want to come back to, I accept. Do we think there's any way of creating a dynamic price setting mechanism here? If the crowd are saying, a kind of maybe, suggesting or asking, just asking, okay, they're asking, how do you arrive at the price? Could we extend that to say, hey, crowd, make suggestions of what the right price is, and we can do a book build? Is that conceivable? Is that asking too much of the crowd? Would technology facilitate that? Is this just Rue being crazy? James?
I think that to some extent that's what Darren's platform is almost doing already in some ways, in terms of having that price discovery. I mean, I think From our perspective, we always invest alongside either a lead angel or a venture capital firm. Normally they're setting the terms of the round. But actually, even in that market, we find that there's room for price negotiation. You know, if a venture capital firm is prepared to commit $2 million to a deal, and actually the company wants to take 3 to 4, and they're looking to alternative sources of finance, then there is leeway. I think, you know, clearly there's a role for the crowd in setting that. I think on the public market side of things, it is more of a science than an art. Having been in investment banking, you know, most of the price discovery is actually what the market can absorb, what liquidity is out there, and actually getting that feedback. But in our space, it's more of an art than a science, and it can depend on a multitude of factors. I mean, it can depend on the quality of the management team, the market opportunity. Most of these things are pre-profit. They've got hockey stick projections. Really, you're taking a view. In the public markets, it's slightly different because normally they've been trading for a lot longer. Actually, you're buying into the growth forecast that they're saying and actually what liquidity is available in the market for that deal. But I think here, and I think the crowd do have a role in that, you know, how should these things be priced? I think having a lead angel or a lead VC involved who actually has experience and can set the terms is incredibly helpful. But if the crowd are providing a meaningful chunk of capital and they don't think that the round should be priced as such, why shouldn't they have a say? And I think actually your platform has been very good at that, and there's probably quite a few examples of where companies have adjusted their valuation accordingly.
Yeah, true. So Gonzalo, clearly the angel model is something that you guys pride yourself on. Can you add some perspective to what we've heard so far?
Yeah, sure. So arguably the valuation is a market force, right? If you have investors willing, and that is on a private markets and public markets, you have investors willing to pay X pounds per share for those shares, and there's a willing seller. That's the price per share. That's the valuation of the business. However, if I may do a slight analogy here, so the reason why we pioneered the investor-led model was precisely to resolve this pricing issue, was precisely to get experienced investors that are putting their own money in and price the business to whatever level that they are happy to risk their own money, see very significant amounts of money. And then you allow the crowd to go in at the same valuation, same price per share. So the whole idea is that pricing event mechanism occurs before the deal goes live on a platform, and you have to find a professional investor willing to invest at that money, at that valuation. Now, if you do a slight analogy, is that, and considering that the valuation is a market force, effectively, it's a result of the market. If you have say a car dealership, right, and you have this really crappy car being sold by X amount of thousands of pounds, if you have enough footfall, someone will eventually buy it, right? If you have this really nice shiny Ferrari, much cheaper, you know, you will sell it straight away, right? The funny part is that in equity crowdfunding or in investment into companies, the Ferrari is actually far cheaper than the crap car, because that's where you're going to make your money back. So that's the irony there. But the valuation ultimately is a market force. If they are willing investors, then that's the value of the business. Will they make money or not? That's a different question. But at that time, that's the value of the business.
It's interesting that, Darren, you talked about, you know, there's a tension here between issuers and investors, and clearly you've got an obligation to both. Do you think, just turning to the issuer side, to the funder side, do you think founders have a good understanding of the problems that funding at too high a valuation can bring further down the line?
I think when they come to us, quite often they don't have that, but we have a team in place that is familiar with that point of view and is there to make them aware of those problems and the drawbacks of trying to achieve too high a valuation. But I think, you know, anybody who's looked at crowdfunding and the deals that have not been successful in particular over the last few years can see, you know, if you're not realistic in your valuation, you're not going to get the money you need to grow your business. And if you don't get the money to grow your business, that's far worse than not getting the valuation that you hope to achieve. So more often than not, I think in the end, people understand that tension between, you know, the valuation and actually getting the money you need to grow your business. So yeah.
Okay, interesting. James, any further perspective on?
No, I think if you've got a good business plan, you've got a good management team, you will raise the money. The question is at what valuation you can do it, and that is a market, as Gonzalo said, as Darren said, that's a market clearing force. I suppose from our perspective, we do have some kind of level of input in the valuations that go through our platform. We fundamentally have to be comfortable that the business is valued at that before we put it forward to our investors. That's key. I think founders are always going to be optimistic, right? They're always going to, by their very nature, they're entrepreneurial, they're going to want to push the boundaries. Sometimes you need to rein them back in. But the successful ones will realise that, and they'll realise that actually what's most important for their business is getting the capital in, enabling the growth, and getting to the next stage.
Gonzalo, please.
I just think that entrepreneurs underestimate how painful a down round is. I mean, a down round is when you raise at a certain valuation, say whatever, 10 million, and then the next funding round you have to raise it at a much lower valuation at 5. So suddenly your earlier investors are already sitting on a paper loss, and that means that they basically get pissed off with you. Then some of them might invest, some others might just completely forget about you and not invest. You struggle to explain to new investors why you're having a down round, what's wrong with your business. And it might be completely fine, and you might be on a growth trajectory, but at the moment you have a down round, you really struggle to attract new investors. And then guess what? We've had companies coming to us with a down round, and then the questions are about 10 times more than when the value is actually going up at a steady pace.
No, that's really valid.
You can kill a company by being over-optimistic with your early valuation.
And particularly, a lot of what I see, people coming out of SCIS rounds looking to raise EIS money, where they've managed to convince a bunch of people that their business is worth £10 million and they're taking in 150,000, and then you go to them, well, okay, is it really not worth that amount?
Yeah, and suddenly with a smaller tax break, it's much harder to get the next round away.
With a smaller tax break and actually more sophisticated investors coming on board, they're often like, oh, okay, reality check.
And that could be the end of the line.
The other problem here is that the valuation of an early stage early stage company is it's something really tough to get, and you have no idea whether you got the right valuation or not until probably about 6, 7, 8 years down the line when the company finally gets sold or lists. And the difference here, in my view, on crowdfunding is that experience lacks. It really lacks that experience. And if you don't have that experience, you have no idea. I mean, even angels and VCs struggle with valuation, getting the valuation right. Crowd that doesn't have the same amount of experience, that they might think and that's worth X million on that company, and they might be right, they might be wrong, but they don't have any comparables. They really struggle with comparables. They don't have that experience on whether, okay, yeah, this company is worth now this much, and then there will be 2 further rounds, and it has to go up, it can't go down, otherwise the company might just die there, even though it's a perfectly fine company.
And I don't think they sometimes understand what these companies will go through multiple rounds of funding. I mean, we were talking about Z rounds, but the reality is there'll be seed, super seed, Series A, Series B, Series C. You really want to keep an upward trajectory. And actually, if you're an entrepreneur and a founder at the start, you'll be sensible and you'll think, okay, well, what actually does an angel who invests in this business need to do to get confidence that they're going to invest in the next round, and the next round, and the next round? And so you've got to show that value growth. You pitch it too high, I mean, really, you're starting to be constrained later down the line.
I actually think you're both being slightly patronising to the crowd there. I think the crowd are a lot more sophisticated than everybody seems to think they are, and a lot of people that I hear criticise the crowd seems to think of them as a bunch of uneducated poor people, where in our experience, they're pretty sophisticated, they're pretty knowledgeable, and they tend to make pretty good decisions, actually. I mean, cards on the table, we had a business that we put live on the site a few weeks ago called Packed Coffee. We weren't completely convinced of the valuation, and the crowd completely balked at the valuation, and they really struggled to raise hardly any money at all. And they were pretty vocal in the way that they fed that back to the company, both at investor events that they ran live in real life, and also through the forum as well. And the company ended up pulling their pitch off there because they knew they'd got it completely wrong. And I think they're going to go regroup and have another think about it, and perhaps come back and do it with a different valuation. So this is an example of actually a dynamic price setting process in action, much more like the feedback, book build, investment banking process. Yeah. Exactly. And so it's happening, basically. It does happen a lot, yeah. Yeah, and you shouldn't get me wrong. I'm not saying that the crowd don't get it. Actually, I think the crowd are very good at taking a view on valuation. It'll be interesting to see longer term how that pans out. Yep. What I'm saying is it's actually, the founders who are driving
They're the ones that always drive the valuation debate, right? Yeah. They're the ones that they're in charge of their companies. They believe that they are worth far more than actually they probably are. Whether it's an angel, whether it's the crowd, whether it's a VC, whether it's public markets, there's always that price discovery element. And I don't disagree with you at all. I think the crowd probably can be quite good at setting.
I actually disagree. I think that parts of the crowd are very sophisticated. We certainly have a lot of members that are sort of private equity, VC back, etc., business angels, entrepreneurs, and so on. But if the crowd was so sophisticated, why would, for example, someone like Brewdog not even bother putting the valuation when they raised finance from the crowd?
They did put the valuation. The valuation was there. It did.
In a prospectus. In a approved prospectus, there was no valuation there. It was the number of shares.
It was there. It was 300 million.
Stay here.
I'm actually going to move the conversation on. I think we've done well down that thread. And actually, I was going to ask two questions about data. And the first one I think we can knock off pretty quickly, because I was going to ask how long until we have a data set of enough successes versus failures to get a sense of an asset class return, to get a sense of, is the crowd paying the right price? And I think Gonzalo mentioned a figure of 7 years, and I think maybe, James, you might have even given me a clue by implication in one of your comments. Do we think that's about right, 7 years? Do we think it'll take that long?
Yeah, it will take a while. And the reason it will take a while is we've got these deals have got to pan out, and we've got to find out actually what they do deliver in terms of return to investors. It's only then that you will actually be able to understand, how successful has crowdfunding been? But actually, what success rate? Did people pay too high a price on the way in? Has that diminished their returns on the way out? I mean, naturally, and we've talked about the length of time you'll be in this asset class, but it's not 2 to 3 years. It's 5, 6, 7 years. And so I think it will be a while before. Maybe some of the later stage VC deals that have got funded, we'll start to see some demonstrable return from them. But I suspect some of the very early stage stuff that we've done, it will take a while to filter through.
So the next question about data then is one around looking for a peer group. So looking for comparable companies when you try and price these companies as they come to you. And clearly you guys are increasingly sitting on an increasingly valuable data set of your own. How valuable is that data set? How easy is it to find comparables within your own past experience? And would there be some logic to pooling that wisdom?
Yeah, I mean, we've funded roughly 300 companies now, I think. So we've got a lot of data there, and we've funded companies at all different stages, all different industry verticals. So I think that is pretty valuable. And yeah, I mean, we're pretty open with our data. I think most platforms, actually in the industry, are pretty open with their data as well. And I certainly wouldn't be averse to sharing that and using that as an industry tool across the board.
And is that?
Yeah. No, I think that's right. I mean, most of the data is there, available to be seen, right? I mean, it's the whole purpose of crowdfunding is that it's open. People can go in, they can see the valuation, they can see what terms the companies are raising at. So, yes, I mean, I think we're collecting a very valuable set of data. I think it's always difficult because, as I said, it's more of an art than a science in some of these things. Until companies get to a later stage, it's quite difficult to put parameters around. Well, even pre-revenue, how do you value a pre-revenue deal? In revenue-generating deals, it's possible. In profitable deals, it's even easier. But I suspect there's an awful lot of variance in terms of prices that are being paid for comparable deals. It comes down to a number of things. We've talked about crowd rating and some of the things that they look at. I look at a number of other things alongside that, but it's a variety of things that feed into that.
Isn't that something that AltFi would do, Rupert?
I was going to say, it feels inexorably like we're heading in the direction of data, and actually, having made a pretty aggressive pitch for my product earlier, I promised I wouldn't do that. But I suppose, while I've got you here, now you've led me in that direction, let's talk about data and standardization. So, do we think more progress can be made in terms of standardizing data? And clearly, that I've had a bee in my bonnet about volumes and consistent reporting and how that could inform. And actually, talking to you guys, it feels like there is a groundswell of kind of support for this principle. Do we think there's more work can be done in that area? Gonzalo?
Yeah, I think there's a lot more work that can be done in that area. I think that the value of data is mostly valuable at an industry level. So sort of AltFi data hopefully will be very valuable to you. To us as a platform, what are we going to compare against ourselves? Well, that information we have, I doubt that anyone wants to pay for it. But we do, we were the first platform to have a page that it basically has every single deal that got funded through Syndicate Room and where they are now, whether they're still trading or not. And I'm very pleased to report that 97% of them are still trading. But yeah, I would like to see a standardization, something that people can compare. No doubt about it. I believe it would put us in a massive advantage as a firm, but not just as a firm, as an industry in terms of, really showing what we are all achieving.
Like for like data. Are we establishing some sort of consensus here?
No, volume data. Look, I've got a bee in my bonnet about volume data. I don't think now's the time to have it. I think.
Go on, get it out there.
No. I don't want to fall out with you just yet. But I think, I very much view it as, okay, what have we delivered? I go to a company and I genuinely say, look, I think I can deliver you this amount of investment. I don't, there's the round that's coming together with all our deals. There's other constituent parts that are putting money in, whether it's angels, whether it's VCs. When I'm ever having a conversation, it's all about what I can deliver to a company. I do worry that the market is being more volume-led than possibly quality-led. I think that we'll see how that pans out in years to come. We are just going to have a complete focus on quality over quantity. We will do lower volumes, but I'd rather do that and keep an absolute focus on the type of deals that we want to back. And actually be able to demonstrate some kind of level of return in 5 to 7 years. That's what's important to me. But I think consistently across the industry, we should come to some set of standards around volume reporting and what we share.
And I suppose, sorry.
I was just going to say, I agree with you, James. I think that quality is more important than quantity, actually. And, I do think that we should be transparent in the data that we provide. But as I said to you before, Rupert, I just wonder who's actually interested in this data. We are as platforms and as an industry and as kind of onlookers and voyeurs to the industry. But are the investors? Do the investors actually care? They come to the platform to evaluate the deals that you have on the site, and they'll invest if they find one that is, suits their needs and is a quality enough for them. Do they care how much the platform has raised overall or how many investors they've got? Probably not.
It's what the media cares about, right? That's what.
But why should we care about that?
No, we shouldn't care about that. And I think I completely agree with you. We should focus on quality. Ultimately, what an investor cares about is how much money are they going to make at the end of the day. Yeah. It doesn't matter whether the crowdfunding platform's raised $500,000 for them or $1 million or $2 million. Yeah. Ultimately, 5 years down the line, am I going to get double my money, 3 times my money, whatever the figure is? That's what an investor cares about.
I'm thinking that I hope we can find Gaddy in the bar afterwards, because I think he'll definitely have a perspective on this. I guess, for me, the point is that it's something to compare against. And actually, on that basis, here we are, an alternative finance event, and clearly we're talking about debt and equity, and there are similar themes in both asset classes. And we've talked a lot about standardization and transparency on the debt side. And actually, one thing I want to pull out is we also talked about skin in the game versus transparency on the debt side. And actually, that's something where your model actually is quite different. And I certainly think that the skin in the game that you bring to bear is actually very valuable in the context of equity crowdfunding. Do you want to?
Yeah, we view skin in the game as a couple of things. One, I have a much longer term view on all my deals. So, for example, if I raise money for a company, I will stay with that company throughout the lifetime of its investment. I will be there side by side with management working through, and I'm doing this on a couple of deals now, follow-on funding rounds, actually trying to help deliver some kind of value creation to my investors. That, to me, I've had a background in private equity. I've always believed in the longer-term incentivization model over short-term brokerage. To me, it makes complete sense, and there's perfect alignment of interest between you and your investors. To that extent, we operate a carry model, so I take a profit share if I've done a good job for my investors. But my investors know that I will be there talking to the company on a regular basis. I'll be feeding back to them and reporting back to them on an ongoing basis about how that's doing, keeping them informed, and just generally being in the flow of information. And it's important to us that actually not only do we actually do that service for our investors, but actually people within the Venture Founders platform would be taking some kind of level of investment in those deals.
I think your model's interesting, James. I like what you do. But my only one criticism is potentially that you are aligned with one side of the marketplace. You're aligned with the investors. You're not aligned with the entrepreneurs. And particularly when it comes to valuation, you're going to drive down the valuation to be as low as you can get it because you are actually an investor. So the entrepreneur might suffer. I'm not saying you would do that, but I'm just saying that if there is one criticism, you could be aligned on one side of the market.
But I mean, that is how the entire private equity industry and venture capital industry in this country works.
Aren't we disrupting that?
We are, but we're trying to allow it to be accessed. So
we're trying to disrupt it and improve it. So
yes.
If there's a way that we can improve it, then we should, right?
Yeah, I mean, my fundamental belief is that the private equity and venture capital industry has been far too private. It should be open to a far wider set of individuals. Now, we've had a debate about what the right level of that is, but actually we're all about giving access to people to that asset class. Yeah. That asset class has been phenomenally successful in what it does, and you can read the BVCA stats, in generating return as an asset class, consistently perform better than public markets, consistently over a long period of time. And there's a reason why, which is an approach of partnership, and generally, having skilled and experienced people within the team who understand investing.
Gonzalo?
Nice to meet you.
I think we sit somewhere in the middle. I think there are ups and downs of every single model here. In our case, what we saw is that we recognize the importance of having skin on the game. And the way we approached it was by having this independent lead investor or lead investors who are putting their money in, setting the investment terms, class of shares, valuation, and they are, risking vast amounts of their own money. And by doing so, then you have an independent source, which is just as valid as James is on you guys putting your own money in, validating the funding round. That's all I want is there an experienced investor interested in investing into this deal? And if there isn't, then I would start asking questions, why not?
Okay, guys, thank you very much indeed. That's all we've got time for.